Welcome back, everyone. Michael here with Offshore Citizen. I have had some clients and other people asking me over the last little while what my outlook is at the moment on the financial markets and where we should be investing and what we should expect on various different investments, etc. So I figured I would take some time to do a quick little video updating you on this subject of what I think will happen over the next 6 to 12 months, why it is that I think that is the case, where I think there is the best opportunity, where I think is the worst opportunity, and everything in between. So let's dive in and talk about it. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. Thank you for your support. If you'd like help with relocating abroad, getting residencies, citizenships, paying the lowest legal amount of tax possible, setting up an international tax structure, investing abroad, etc., please reach out to us. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below, or send a message to our websites, offshorecitizen.net and offshorecapitalist.com. Okay, so very briefly, the macro view on what I think has not really changed since I kind of described the overall structure previously. So back the last time I gave one of these updates, I basically laid out a case that was largely dependent on whether you see Fed tightening or not, and using inflation as the key wild card that may drive their decision. We didn't know what was going to happen at the time. We have since got that information, and so it more or less just puts you into one of the channels that I was describing at the time. And so there's an underlying expression that we have often in investing, which is don't fight the Fed, meaning when the Fed starts printing money and putting a lot of money in, it's easy for things to go up. When the Fed is tightening and raising interest, etc., it's easy for things to go down. And it's really difficult to play the opposite side of that equation. When I do technical trading, one of the key lessons that I've learned is that most of my losses are when I try to trade against the trend. Not that you can't make money that way, you certainly can, but it's much easier to trade with the trend. And so when we look here, we've seen a bunch of asset prices come down dramatically in public markets. So if we're talking about growth stocks in particular, or tech stocks, we've seen, anywhere from 50 to 80+% declines in a bunch of companies, some of which are really good companies. And so on the one hand, you might be saying, well, you know what, it's like really attractive valuations. The problem I think with that is we have a distorted view because things were pretty expensive at the end of 2019. And then by the end of 2021, or maybe 2020, like whenever they peaked, depending on the particular stock, it was much higher, right? And so things had gone way up really fast, and a bunch of them have come down, and it might look like they're cheap, but they're really not that cheap. It's more like a lot of them have returned to a normal valuation. It just looks cheap because we had this artificial sense of how things were worth during kind of a 2-year period of intense stimulus, right? So I do think that we're going to find some really attractive prices, and I do think that there are some great companies that are available at good, attractive prices. The kind of maybe exceptions to the ones that went up are Chinese tech stocks, so in particular Alibaba, Tencent. Those would be two examples. You see some others that are not necessarily Chinese, but there are other places. C Limited would be a kind of an example of this. And so you've got those types. Then you've got some that never really went up. You see companies like Ubisoft that is around like a 5-year, the same level it was at 5 years ago. So I think you get certain companies that of course are relatively down. Some are trading below their IPO level. For example, if you look at something like Beyond Meat is quite a bit down there. So you do get some of these, right? On the other hand, what you see is a trend where there is capital being sucked out of the market because the Fed is tightening, they're wanting to do more tightening, and you've got rising interest rates. So you've got those two things which are already negative for asset prices. When you add inflation onto this and recognize that inflation is quite likely going to drive us into a recession, you have 3 very negative factors in the macro. And so I expect that pretty much all the risk-on assets are going to see some downside. I don't expect to see the same amount of downside in real estate. Real estate's hyper-local, right? So that's a whole other thing in and of itself. So you can't really generalize. But this being said, as a general rule, real estate tends to trail stock market prices. And this is really logical why this happens, right? If you're in a situation where you're trying to do real estate transactions compared to trying to do stock transactions. You can sell really quick in the stock market. It can take you quite a while to sell in the real estate market. And it goes both ways. Real estate tends to go up later, which we saw in housing, right? Housing kind of went up after stocks went up, as well as goes down afterwards. And you can see if you look back to, for example, the stock market bottom for 2009, like kind of the post-financial collapse of 2008, was in March 2009. And depending on the market, again, a lot of different areas, but you were talking somewhere between 2010 and 2012 that the US housing market bottomed. So, you know, like you can see how there's different effects here. And so I don't expect, real estate's gone up a ton over the last while in a lot of parts of the world, and it makes me a little bit leery. I told a client the other day, I don't like to buy things that have just gone up a lot. I like to buy things that just went down a lot. That being said, I think some markets will still continue to do well for a period of time. But, you know, I think that, and I don't think that we'll see the same level of downside that you're going to see in some of the stocks, just because of the fact that I don't see that the leverage levels are there in the same way that they were in 2008. But I do think that it's probably at a later date going to see some sort of downside from the price levels, whether they go up a little bit more before they come down. How that works, again, varies market to market, but that's kind of what I'm expecting. So yeah, number one, I expect to see downside over the next 6 to 12 months greater than we've seen already in, you know, whether it's the broad crypto markets, whether it is the stock markets, etc. I'm expecting to see that. Now, I do expect to see some rallies in between. So I don't think that this is like a straight way down. In fact, yesterday or the day before, something like that, I bought a bunch of some particular assets. And so that was kind of, I'm playing that as sort of a short-term trade. So it was, hey, listen, I could just kind of look and see that it looked to me as though things were pretty oversold. The technicals were kind of bottomed out. I saw signs that that was slowing and, you know, going to reverse. And so I put some money in just in order to catch this upside for, you know, a little period of time. And I expect to take profits on it and then go on to the next one. So that's generally my perspective. What does this mean? This means, as I said previously, because you can't necessarily get timing right, you should be more focused on high quality assets right now than you would be in some other times. This is not a period of time where you can just buy anything and have it go up. High quality assets matter a lot. Number two, because timing may be wrong, I like anything that produces cash flow or at least some sort of yield, whether this is, you know, you're dealing with some sort of cash equivalent with yield, or even an asset like real estate that gives you cash flow, etc. I wouldn't want to be buying raw land, for example, right now. Somebody sent me a piece of land yesterday, the day before, that actually looked like a pretty good deal. It looked pretty large and things like that for the price. But I would not want to be in that position right now. I would want to be in a position where I'm buying something that is going to give me cash flow. If I'm wrong about the timing and things keep going up, I'm still getting cash flow. If I'm wrong about the timing and things are going down, I'm still getting the cash flow. And I want to do that on a high quality asset. So in my opinion, that's the best way to be going right now. My idea is buy high quality assets that provide you with yield and be prepared to hold, unless you're doing some kind of a short-term trading strategy. So we'd love to hear what you guys think. You can put them in the comments below, and I will look forward to seeing you on the next video.